How's the audio? Well, if you can hear me, just put something in the chat, please. That would be very helpful. I don't know what the latency is like on the stream. I think it's like 30 seconds. You can either tell me in Discord or on YouTube. Okay, so today we're going to be starting with student chart reviews, and then we're going to be going into what do you call it? Swing grading. Grading implied ranges. I've gone through implied ranges lightly before, but this one will be a little bit different. Today we're going deep. Can be better. That's reassuring. Oh, the latency is huge. Okay, we'll just have to deal with that. Okay, we're going to start with Clinton's trade, Mojelb. So his trade, if I just bring it up, bear with, it's my first time managing a stream. Okay, his trade was here on the 21st of August. Market open. So I'll go to trading view. So immediately at the market open, what's the first thing we're looking for? We're looking for liquidity, we're looking for the ranges, we're looking for where we're likely to draw towards. Now, on Wednesday we had that massive unexpected move. My bias for Wednesday was to trade up in here because it was the original consolidation of the market maker buy model. But we failed to break the pre-market high. We come out and take this protected low, or this protected low, and then we keep dropping, and then that's where I sold. How could you have been confident in the fact that it was going to keep going lower? Well, we sweep these highs over here, consolidation highs. We're going to be talking a lot about consolidation today with our swing grading. Looks like just need to change this. Yeah, and then we'll be going through consolidation a lot. Sweep this high, displace lower. That's bounce price range because that's an overlapping BISI, an overlapping SIBI. So ordinarily we could come and say this entire thing is a bounce price range. And true, but there are different types of bounce price ranges. You can get bounce price ranges with just wicks. So if I can find an example, here we go. This technically is a bounce price range. Do you treat it like we would treat this bounce price range? No. This bounce price range is an overlapping BISI and a SIBI. What is that a sign of? It's a sign of institutional order flow entry drills. So when you see a bounce price range and it's external, so you sweep a point of liquidity, in this case consolidation highs, and you displace lower, getting an overlapping BISI and an overlapping SIBI within the same range, you'll want to look for institutional order flow entry drills into pools of liquidity. So in this case, that'll be the pre-market low for your low-hanging fruit. and then we had the daily relatively equal lows from the 20th of August, and then we just kept dropping. So in this case, we had that bounce price range. Then we had our first presented fair value gap on the 930 candle. Why the 930 candle? Oh wait, one sec. You don't know what a BPR is. A BPR is overlapping price delivery within the same range. Don't worry about it. Just pay attention to this part with the first presented fair value gap. Why is this our first presented fair value gap, and why are we looking for an entry in this one? We had the bounce price range. We have drawn liquidities lower. We sweep the consolidation high, and we'll come more into sweeping consolidations in probably like 10-15 minutes. And price gives you the institutional order flow entry draw. Why is this the first presented fair value gap? Isn't it meant to be 9:31 and until 10 o'clock? Well, we can treat it as our first presented fair value gap, even though it's a 9:30 candle, because on the regular trading hours chart, if you pay attention, I'm on the regular trading hours chart now, our 9:30 candle opens where? Below a low, below relatively equal lows, so it opens below liquidity. In that case, you can use the 9:30 candle as your first presented fair value gap. Go back to it. Yeah, so to be honest, my bias on Wednesday was also to go higher. SL above BPI, yes. Your stop loss would go above the bounce price range because I'll remove this and I'll put that back on. Because you never want to see price trade back into the midpoint of a bounce price range when you leave it. If you have a bounce price range that is like this is consolidation. Technically, it's a bounce price range. Do you treat it the same as overlapping inefficiencies? No. This is an overlapping BISI and an overlapping SIBI. It isn't the same as a consolidation, because even though this is a bounce price range, this is a more powerful one. It's inefficiencies. So overlapping inefficiencies, overlapping displacement, you don't want to see price trade back through that. So you could be safe putting your stop loss, if you enter on the institutional order for entry draw, putting your stop loss right above the midpoint of the bounce price range. The max it should do, even with a wick, it shouldn't come past the midpoint of this bounce price range. Okay, that's that trade, and then we look at the next ones. ICT. It's not a personal observation, it's from ICT. I have many personal observations, but I'm not teaching those today. Okay, so this one is from buy low, sell high. I don't remember what date this is, so I'll just have to use his chart. So our pre-market low, again we're going into the market open. Pre-market low, this is sell side liquidity, buy side. This isn't a trade, this is more hindsight analysis that he's done, he's asked me to review. So we take buy side. What do we distinguish between a run on liquidity and a sweep? A lot of people will tell you a sweep is with a wick, and only if it's with a wick do you want to see a reversal. That's not true. You can have candle bodies go through it, as long as you displace lower within a reasonable amount of time or a couple candles. Going through this, setting a wick, getting this bullish order block, sorry, not bullish order block, these three down close candles, and then getting this stop run, that's a sign that it is a sweep and you're going to keep going lower. Why? This is the final run on buy stops before dropping lower. Obviously, in hindsight, that's very easy to tell. Say you were in that. You're reading the chart and you just sweep that high. And you also have this S&T. You can't see on the chart, but there's also an S&T. That's a higher probability total soup. Why? High. This is a high. This is a higher high. and this is a higher high. What is that? The sharp ones among you. That is a 3 drives pattern. Now, a 3 drives pattern, it's not a retail, well, it is a retail concept, but it works in ICT concepts as well. ICT teaches it. So a 3 drives pattern combined with an SMT is a super high probability reversal. And if you go into the Discord on August the 20th, when I was calling that the market from that 3 drives would go lower, so you got a consolidation and then jump into the original consolidation high. I'll show you that in a second. That's what I was using. So this 3 drives pattern is a high, a higher high, and another higher high. If you get that with an SMT, really powerful reversal pattern. If you get it with an SMT near a pool of liquidity, be it buy side, or in a bullish example, near a sell side liquidity pool, very high probability reversal, and you can always trade that. Reviewing the rest of the chart, I'm not sure why this is labeled as a breaker block, because it isn't a breaker block, but it's fine. If I was trading this, my entry would be on this bearish order block. Why is this a good entry? Because obviously you have 3 drives, up close candle displaces lower below that. So we have this up close candle, the white one, then 2 down close candles displacing below it. Trade back into the order block high, almost perfectly, and then you reverse off this candle wick. If you miss your entry on the order block and then you see it react to this wick and then you drop and then you come down below here, you can also enter on this order block, which is what I would have done. I don't think I was in that trade though. This is a Reaper fair, no, it's not a Reaper fair value gap, it's an inversion fair value gap, which gives you another entry, but this is after equilibrium. We always say you don't want to buy in premium and you don't want to sell in discount. Today I'm going to be teaching you something where you can. It's nuanced, we'll go into that more. But you could have added to your entry here on this inversion fair value gap if you were confident in your drawn liquidity. Now, if your drawn liquidity was this low here, and you're that close to your target, are you going to add to your position? Probably not, because you're bringing your average entry price lower for not even that much reward. But if you're targeting this London low, or if you're just going to let it run until you get an opposing SMT like we had here, then that is absolutely fine. Okay. Next up on the chart, again from buy low sell high, we have a one-sided sell side delivery move, pullback, and then another one-sided sell side delivery move, which makes the pullback not just a Judah swing, but it makes it a fulcrum. And my friend over here, buy low sell high, has done a very good job of projecting that range with a fulcrum and standard deviations. Now, in the video I taught last week on fulcrums, I taught you 2 types: continuation fulcrum and a pullback fulcrum. This is the pullback fulcrum. And if you remember, I mentioned that you usually want to target 1 standard deviation, which is an equivalent price move. So in this case, say this is 50 handles, 1 standard deviation will be 50 handles away from this swing. So 50 handles lower, for example. It's not actually 50 handles, I don't know what it is. And yeah, that reaches very well. Why do we not use anything past that? You can if the pullback is smaller. In this case, you have a fairly decent pullback where you trade into the upper half of this price, this sell side move. So that's premium pricing before dropping lower, again giving you the stop hunt. The reason I would close a trade on -1 standard deviation is because we have a low, a lower low. Do I want to see a lower low and then purge and revert into these relatively equal highs or these smooth highs? It's possible. So I would have taken my position off there if that was me in a trade. This is just hindsight though. So we have this institutional order flow entry drill where we trade into this fair value gap. Why has he used this fair value gap and not this one? Because when you have 2 fair value gaps like this and you're anticipating a retracement, whether it's premium price or just normal price or discount pricing, you always want to anticipate it coming into the fair value gap that's further away from market price, which would be this one. And that's an institutional order flow entry drill because it only gives you an entry by a couple ticks. That's a sign that the algorithm is about to spool. It does, and then you get your second entry, which doesn't break this high. This is a protected high, it's an intermediate term high because we have it inside of a fair value gap, and we have short-term highs on the left and right of it, making it an intermediate term high. If that got swept, you probably wouldn't, or sorry, if it got ran through, you wouldn't be looking for lower prices, but because it did, you can look for lower prices. Bearish order block, sell side move, institutional order flow entry drill again, and then once again, so that's really good price delivery. I'm not going to go through the market maker models, but I will go through somebody's silver bullet trade. I'll check the chat too. The live stream is going to be saved on the YouTube, so if you need to come back later, you can do that. Okay, so we're looking at a bit more of a messy one right here. So this is from student Dev, who's got a lot of indicators on. My first recommendation to you, take all of those off and start looking at things manually. Indicators are not going to help you. A lot of the times they're going to mark things up the wrong way, like this minor inducement. What inducement? This is just not inducement, it's consolidation. So, you know, get rid of these indicators. They're not doing you any favors, they're not helping you. You can see where market structure shift is, and if you can't, you need to look into that more and practice seeing it on your chart. He hasn't given me the dates, so it's kind of hard to look at this, but we'll try. So if you look at the times here, this is the pre-market range, that's our pre-market low, that's our pre-market high. We kind of trade into the pre-market high. That's bounce price range. You would expect lower prices. It does give you sell side delivery into the other side of the pre-market range with a sweep. And it takes out that side again. This is a mess. You wouldn't really want to trade this price action. One second. Let me find the other chart that he sent me. Okay, this here is a good buy from him. So you get stop hunt, and then you get market structure, not market structure shift. You get a buy side displacement move, buy side delivery, retracement into a fair value gap, and then you run higher. And then he entered over here. Oh no, he entered over there. I wouldn't have entered over here because we don't have anything to confirm buy side, a buy side move. There's no change in state of delivery, and there's no market structure shift. So you always want to validate your longs with some kind of break in market structure shift, change in state of delivery, a displacement above an order block, and then entry into the order block, which we just don't get here until this point. This would be your secondary market structure shift. Why is it a secondary market structure shift? Because your primary market structure shift would be the initial significant swing high. This was formed after the liquidity sweep. So do we trust this market structure shift? You can, but is it as strong as this one? No. So even though this is a market structure shift, it's less trustworthy. It's still good. It's still fine, especially when you have buy side draws. And his entry was premature in my opinion. I would have taken it on the fair value gap over here because that's when you get the secondary market structure shift. And that was a good trade into the end-dog cluster because you have a new day opening gap and new week opening gap. The only advice, get rid of the indicator for inducement and stuff. Keep the kill zone stuff on. Yeah, declutter your charts, man. Open, high, low, close is all you need. Okay, next is... Who else sent me a chart? Someone else sent me a chat, I need to remember who. How's the audio, by the way? Is it okay? Okay, silver bullet. We're going to be looking at silver bullets. I didn't prepare any silver bullets, so I have to find one quickly. This will do. Silver bullet time window, 10 o'clock to 11 o'clock. I'm going to make this quick because I want to go into swing rating. I'll have to get rid of this one because it's covering up the wick. Low, lower low, lower low. Again, that's that 3 drives pattern. And this is also your turtle soup entry. You could take that as a long into these highs. Now you might be thinking, if this was a silver bullet buy and it swept it low, and then you get that a change in state like this, market structure shift as well, you don't get a fair value gap entry, but you get an order block entry. It didn't go into the opposing pools of liquidity, so is that a loss? No, because if you read through the section in Discord where I teach the silver bullet, I teach that you should always take your partial and set it to break even once you've traded into equilibrium. There isn't that much to cover with silver bullet, it's so simple. I'll do London silver bullet. So here is, I must have accidentally taken the indicator off. I'll draw out the London range. Okay, this is London range. Do you need to sweep previous day high, previous day low, previous week high, previous week low, previous month high, previous month low, previous session high, previous session low? No. For silver bullet, you don't need that. Is it better? It can be. You're probably going to see bigger moves when you take out the previous day high or the previous 4-hour high or the previous week high. Is it fine to take out internal range liquidity like this? Absolutely. Are you still going to get great trades? Absolutely. Now this is all a sequence of higher lows. So we have higher low, which are also relatively equal. Higher low, smooth high, smooth lows, smooth lows, smooth lows. That makes this entire thing low resistance. Is it realistic to expect a trade through all of that in one session, doing London? Yeah, because it's only 60 handle range. So even though it looks big right here, on a macro scale, it's not big at all. Okay, so we sweep out this consolidation high. Now, why am I not saying relatively equal highs? It is relatively equal highs, but I'm mentioning consolidation highs because we're going to be going into it more later. Consolidation, consolidation, consolidation. You can enter silver bullets sweeping out liquidity that is internal, even if it's consolidation. And then you get your market structure shift, you get your fair value gap, the typical stuff. Where would be your highest probability entry? Not the one that's going to give you the best risk to reward, the highest probability entry. The one that's going to give you, the biggest likelihood of hitting take profit. Well, you get your market structure shift. Is this your market structure shift? It is a market structure shift, but tying back into what I said earlier, it's the secondary one because it's the one that comes after you sweep liquidity. So you get the stop run just by a tick. That's your sign that you're getting speed in the marketplace now, because you've taken out the low, you've rejected from it. It's only needed to go up by a tick. That's a sign of algorithmic presence, so to speak. Secondary market structure shift. Am I trading off that one? You can. Is it the highest probability entry? No. What is the highest probability entry? this low here? Why not this swing low? I don't know, there's only one. Why not this swing low or this swing low? Because this one was created with the most speed. This ties into the difference between market structure shifts and market structure breaks. Is this alone a market structure break? No, but it does have more energy than these lows. It was created with more energy. So this swing point was created via sell side displacement, not a little retracement, not a little down close move, real displacement, heavy energy down. So that is a significant low, and you can treat that as a market structure shift. It isn't quite a market structure break. I still need to teach the difference between those, but this is your primary market structure shift. Again, it's because this one was formed prior to the liquidity sweep. Anything after the liquidity sweep is still valid. You don't want to be going in with huge size just because you get the market structure shift after the liquidity sweep. You want to get your market structure shift with a swing point prior to the liquidity sweep. You can backtest that yourself, and yeah, implied fair value gap. I'm not seeing it. Okay, where would your entry be? So this is your market structure shift. Entry on this bearish order block, on this fair value gap, this SIBI. You have a lot of entries here. There, or there. And remember, order blocks are going to be coming in later. It happened after 3 o'clock to 4 o'clock window. Is considered silver bullet or just 2022? I don't even notice that. Now it is silver bullet because it happened. The setup formed between the time period. Your entry doesn't need to be within the 3 o'clock to 4 o'clock hour, and your liquidity sweep doesn't need to be within the 3 o'clock to 4 o'clock hour. As long as the foundation of the setup is there, it's fine. Like, it's loose timings. Generally, the safest thing to do is extend it to the macros. So from 250, this macro, going into 310, and then 4 o'clock is your silver bullet hour, and then you extend it to the last macro, 410. And this is the general range you want to see your liquidity sweep in. But with kill zones are a bit flexible with the timings, as in you can add an hour onto any of the kill zones if you don't get the move within the first, well, for London it's 2 hours, but say New York AM, you don't get the move, which is very rare for New York AM because it's so volatile, but if you don't get the move within that 1.5 hour time period, you can add an hour. With the London kill zone is actually from 2 AM to 4 AM, but we add the hour to 5 AM, and now it's generally been popularized as being from 2 AM to 5 AM. This is like the standard London kill zone timing. The original kill zone timing was up to 4 AM, but when you don't see the move you want, you can add the hour, and because of that, it's popularized, and even ICT teaches it now as up to 5 AM. If you go back into his earlier teachings, it's up to 4 AM. Okay, that's silver bullet pretty much done. I want to go through swing grading. Oh wait, no. There's someone else's chart that I need to go into. Dennis. Where are you, Dennis? I have to find the chart. Okay, I found it. Oh, it zooms in a lot. Oh I'll zoom in from OBS. Okay, that should do. So we're on the hourly chart on the Eurodollar. This is Dennis's chart. Let me just have a drink of water. Getting dry mouth. Okay, we've got sell side liquidity. I wouldn't really be caring too much if it's kill zone liquidity on an hourly chart. It's fine that you labeled it, but I just wouldn't really care that much. Buy side delivery, retracement in the form of consolidation, and then we sweep that retracement. Okay, I'm going to be teaching this specific trade opportunity later on, but just keep in mind retracement and then we sweep it. Buy side delivery again. Okay, I don't even know where the trade is here. It's kind of a weird chart. Advice for you, Dennis, you don't need to be labeling every single high here. Just eyeball it, man. Like, it gets cluttered when you're looking at this so much. I think the trade is from... I don't know what the trade is here. Let's look at this one. Okay, here's the trade. Okay, this is good. This is very good. Let me zoom in. So it zoomed in a lot, which is a bit annoying, but it's okay. Sell side delivery move. Retrace into this bearish order block, plus this little fair value gap. Then this is our bounce price range. So what we mentioned earlier when we were looking at Clinton's chart, we sweep liquidity, then we have this overlapping BISI and SIBI. You can treat that as a bounce price range, and then you can expect an institutional order flow entry drill. Do we get one? If you're using, no, we don't get one until there. So we do get one, but it wasn't part of his trade. If this is a 1 minute time frame, you could have held for a lot longer, because when you get the bounce price range and you displace away from it, typically I hold it until I see, let's say I was in this trade, I wouldn't let go of this trade until I get the institutional order flow entry drill, and then I would ride out the move from the institutional order flow entry drill. Now you don't need to look for the entirety of the institutional order flow entry drill, the move off the institutional order flow entry drill, but because we had the bounce price range that took out liquidity, what I would do in this scenario is hold the trade until we get some major displacement off the institutional order flow entry drill, and I would only give it a certain amount of candles to react. So once you displace away from it on the first candle, which is your institutional order flow entry drill, you let that little bit of displacement come, and it's just going to increase your risk to reward. It's going to offset some of your losses in the future. It's just useful. Okay. Where's my chart? I already went through your chart, but it was trash, so sorry. It was right at the start. I showed it on my trading view instead. Okay, why was that not a proper 3 drives? And this stream delay is annoying. I'm gonna have to get rid of the stream delay later. Okay, into the meat and potatoes of what we're teaching today. Swing grading. So what I'm going to be teaching is relatively simple. Now everything from here and the rest of the stream is going to be only related to trending market environments. Now it can be on any time frame. It doesn't need to be on a daily or a 1 minute or a 5 minute. It can be anything. So as long as you're trending on that specific time frame, this will apply. I'm not going to be reading the chat for a while. Drink more water. In fact, we'll make this a bit easier, and we'll just use a line. So what is swing grading? This is how banks are getting into their orders. So what I'm going to be going through is grading the price swing. Now it's not just any price swing, it's the implied price swing. So not price swing, the implied range. Where is the implied range? An implied range is from the origin of the move that you're looking at into the terminus point, aka just your draw on liquidity, where you believe it's going to go, where it hasn't gone yet. In fact, I need to put market replay mode on. Say you're here. Oh, I'm going to get rid of these drawings. Where is the implied range? You can say it's from this low to that high, because this is the origin point of the move. Or you could say it's from this low or this low, because the impulse swing. Any of that's fine. It just depends on your preference. So an implied range is the point of origin of your move, which in this case it was literally right after the second we got an up close candle. It was there, into the terminus point of where you're expecting price to go. Does that mean if price doesn't go all the way there, your implied range is wrong? No, but if you're anticipating a one-sided move in the market, that would be your implied range. So if I just say that this is the price one we're looking at, and this is your implied range, and you grade this fib or this price move with your fib, you go from the low to the high, and now you have the 0.25 level, the 0.5 level, and the 0.75 level. What we're looking for is pause points. So in a price swing, we're going to get 3 trading opportunities. That is from the origin up to the discount. Sorry, up to the equilibrium. From equilibrium down into discount. So you trade just above equilibrium into discount. And from the upper quadrant, which is a 75% level, dropping back into the equilibrium and then trading back into your terminus point, or the high of your dealing range. Implied range, sorry. We're going to come into those trading opportunities later, but what you need to understand now is the market is likely to consolidate or likely to give you pause points, not necessarily consolidation. It's likely to give you pause points at the general area of these levels. Doesn't matter like how far or how big the boxes are for now, just think of it like this. Hang on, let me read the chat. No, it's not a dealing range, it's an implied dealing range. Just a second. Bear with me, people. Okay, so we all know from core content, you get the 2 stages of price delivery being expansion, consolidation, consolidation, expansion, consolidation, expansion. So consolidation and then expansion. Now in swing, with the concept of swing grading, we're expecting, or we're waiting, a lot of this is waiting for consolidation to be swept in order to get into trades. Obviously you can combine this with PD arrays that are supporting it, like fair value gaps and order blocks, but we'll come into that a little bit later. This is my first time live streaming and I'm very bad at it. So in a price swing, where are you more likely to get consolidation? At equilibrium. and at the 0.25 or the lower quadrant. If this was a buy move, if we're looking at a buy move, we're likely to get consolidation or some measure of retracement at the lower quadrant or at equilibrium. You are less likely to get it at the upper quadrant. It's still possible, don't get me wrong, and it still happens, but it's just less likely. So midpoint is where consolidation is. You won't know how long consolidation is going to be. That's the only thing we don't really know. So say we trade up, we get this little retracement, and then now we consolidate. How long is that consolidation going to last for? I don't know, you don't know, ICT doesn't know, nobody knows. So our goal is to capitalize on price trading lower than the consolidation in order to fuel a run higher. Why is this run higher? Why is it important that it drops below the consolidation? Because retail orders are here and they need to be paired with the large funds who are trying to force in billions and billions of dollars into a trade. Now, as many retail traders as there are placing stop losses below this consolidation low, is there $50 billion worth of stop losses below 3 little tiny lows? No. So are the banks who are forcing in billions of dollars into the market, and the large funds, the hedge funds, the people that are owning pension funds, are they able to put in all of their money into just this point here? No, because if they did, it would just be super low, straight up. So it happens gradually. Large funds push their money into the market gradually because it is physically impossible to have that much opposing liquidity on the side of the marketplace that they're trading. So if they want to buy with $30 billion worth of whatever in the NASDAQ or in gold or in the euro dollar or in pound dollar, they still need people on the other side of that, and that doesn't happen just at one little consolidation low. It has to happen gradually, and that's why this is gonna always work. People in the Discord like a week ago were saying ICT's become more well known, the algorithm's changing, whatever. This isn't changing because this is just how the market works. There will always be larger funds who are looking to make a profit, and the only way they can do that is to have opposing liquidity, and the only way that can happen is for this concept to play out. One second again. So as I said earlier, we're looking to see consolidation within the range of this box. It doesn't need to be consolidation, it can be retracement, and we'll come into that when we go into our chart examples later. But you're looking for that retracement / consolidation around here, and then you're looking for price to take out this low and then energetically move higher. Why will it be more energetic on this, the second price leg, this price leg, than the first price leg? Because we've consolidated and we've fueled that low. So remember what I was saying earlier with consolidation, expansion, consolidation, expansion. The second you sweep this and you trade into an area of support, then you're looking for a more faster, energetic displacement higher. That second leg is usually 90% of the time going to be faster than the first price leg, and if it isn't, be cautious. The reason I'm teaching this is because it's going to allow you to anticipate where consolidation will occur and where you're going to start moving off. You can align this consolidation with your lower time frame trade. So say you were doing this on an hourly chart, and then you drop into the 5-minute chart, and you're looking for the ICT Classic buy day template. And you're looking for the ICT Classic buy day template. I've said many times in the Discord that is my highest yielding model, And you know what I always align my buy day templates with? This concept here. Trading through sweeping consolidation lows within one of these little boxes, and I'll go into more detail about the boxes. And then the reason for that is because you're anticipating speed, especially when you're in the second leg. You sweep out this consolidation, you're likely to go higher. The most important part of trading this concept is knowing where price is going to go. Obviously, that's very easy to say, a lot harder to do, but it is simple. You literally just identify a drawn liquidity, relatively equal highs, or a high there, like I'm on replay mode, but this high, this London kills on high. We're doing this on the 1 minute chart today. I encourage you to try it on higher time frame charts. So in between the origin of the price move and the terminus being your implied range, there are 3 trading opportunities. You got each quadrant that you can buy in. So you have the lower quadrant, the equilibrium, and the upper quadrant. If you miss the trade opportunities in the discount, even though you've missed out on the lines share, the lines portion of the move, you shouldn't worry because you still have the opportunity to trade from the 0.75 quadrant. Now, I don't mean just buying in the 0.75 quadrant. What if price just takes off without you? It doesn't give you that stop run on these consolidation lows. That's when you're likely to see something else very specific. So, consolidates, and doesn't take out the consolidation low, and it just runs up higher into 0.75. What are you looking for to see now? Now you're not looking for this consolidation to get swept. Now you're looking for an order block to buy in. And that's your trade. So that's your third trading opportunity. So say you don't get that tail sweep entry when it sweeps out this consolidation. You're looking for the order block to buy in once you leave this price swing into the upper quadrant and you retrace into the order block. Obviously this looks like a fair value gap, but pretend this is an order block here. Okay, we're going to go to our chart example now. And also read the chat for questions. What's the difference between dealing range and implied dealing range? A dealing range is when you take out both buy side and sell side liquidity in one price move, or in a range. An implied range is different because you're looking at where price is, and where price is likely to go. Yeah, so implied range, right, that's where I was, just lost myself. Where is the origin here in the price move? It's from the impulse price swing. It's probably easier to show on a chart, but I'll get to it in a second. The impulse price swing is where price moves energetically off a swing point towards, not necessarily into yet, because in hindsight you can see that it's gone into that, but in real time, and you're trading this and you only got this part of the chart and it takes out the low and then this impulse and it gives you the market structure shift. Now you're looking for it to trade into a terminus point. Terminus point being your drawn liquidity, relatively equal highs, significant highs, whatever. So your implied range would be from the point of origin into the terminus. Do I use fib optimal trade entry? Yes, but we're not going into that with this. It's not relevant to swing grading. Okay, I'll show you how implied ranges work on a real chart. How about that? There we go. So where does this price move begin? The buy side price move. You can argue it begins here on this swing low, or here on this swing low, or here. I would argue this one, because it's our first up close candle and it begins the entire price move. So in this case, it just looks like a dealing range, to be honest. It doesn't even look like an implied range. Let's check out the euro dollar instead. We'll see if we can get anything. I'm sure I marked out something. Maybe not. Oh, here we go. Okay, we're going to go into a high time frame chart. No, let's just check the daily instead. Here we go. So say we have the initial displacement move to the upside. That's your point of origin, and then your terminus point is your draw on liquidity. So these relatively equal highs, that is a good terminus point. So you could use this as your implied range. I would use this one because this is a market maker buy model. Distribution lower, redistribution lower, small mirror reversal, distribution higher and higher, and then into that consolidation. One second. Just give me a minute. Okay, back. So you want to ignore everything to the left of this in terms of price action, because the implied range begins post this low forming. So anything here is what we're considering our swing grading. So we get our consolidation around 0.25. Why these boxes, by the way? Why these boxes? You're just looking at the general area. It's not anything specific. It's not a specific amount of handles or pips or size. It's literally just you draw a box and you look for consolidation around that. It's that simple. Don't overcomplicate it. Don't overthink it. This chart is distracting me. Put this over here. So you get consolidation at our lower quadrant. We trade through equilibrium, and we react off 0.75, and then we go into this bullish order block plus fair value gap. So remember earlier I said we have 3 trading opportunities, one inside of discount, well 2 inside of discount, between the origin of the price move into equilibrium. Then when you sweep the equilibrium's low, in this case we didn't get any consolidation at equilibrium's low, we just ran right through it. Then we traded into this little bullish order block plus fair value gap, and that would be your last opportunity to get into the move. Would you consider anything after 0.75? No. Generally, you're going to see that the majority of consolidation happens at 50% level, not at 0.75, so this is a bit of a different example. But then, if you drop time frames and you align that consolidation with your lower time frame trades. What do I mean by that? we all know time is fractal, right? Price is fractal, time is fractal, everything's fractal. So say you're looking for an ICT Classic buy day template, and you're aligning it with the idea that you're going to sweep out the consolidation that happened in between equilibrium and 0.75, or your upper quadrant, and then you wait for price to trade below the consolidation, which is here, and then you buy. And you can align that with your trades on the 4-hour chart, and then obviously you get this bigger move, because think about price delivery. Consolidation leads to expansion, and then expansion leads to consolidation, and then the other way around. So expansion, consolidation, expansion, consolidation, consolidation, expansion, consolidation, expansion. That is the entire premise of swing trading. So this consolidation is gearing up the market to start expanding to the upside. Why do we need this consolidation? We're accumulating orders, and we're giving the opportunity to large funds to enter once that consolidation low has been manipulated. So once we've manipulated the low of that consolidation, what are we looking for? If we have an underlying idea that the market is going to keep going higher, and in this case we're looking at a market maker buy model, then any sweep of a consolidation formed at or between these points, the equilibrium and the upper quadrant, is something you can look at to consider a buying opportunity. Does that mean every single time you go below the consolidation in a bullish market you're going to trade higher? No. Is the likelihood that you are going to trade higher in your favor? Yes. And you can drop another time frame, go to the hourly this time, and we'll look at the 0.25 level. So anything post here, because that's where our point of origin started. Consolidation, sweep out the lows, expansion, consolidation, expansion, again consolidation, take out the low through drives pattern, consolidation, sweeps out the low, expansion, consolidation, sweeps out the low, expansion. So the idea is you're just looking for consolidation within these quadrants. I don't really trade ICT, but would you best find your range / area for the setup? I suppose you'll show examples which we could see why the difference. Oh yeah, I read this. Man, talking makes me thirsty. 1 second. So coming back to the idea of trading opportunities. In fact, let's go to the Nasdaq now. Oh, this one. Yes, it was. We'll go to on the 5 minute, and then we'll drop it down time frame. Point of origin of the move here. Terminus is this relatively equal highs, and that is your implied range now. Let's put this on, and you literally just draw some boxes. Simple, isn't it? Doesn't matter how big they are. It's not really prevalent. We're looking at the general area in these quadrants, and then we're looking for consolidation. Now we don't get anything on the 5 minute of the 0.25. Generally, you're more likely to get a retracement at the lower quadrant, consolidation at the equilibrium, and then a shoot higher through the upper quadrant into your drawn liquidity. because the upper quadrant is generally not going to provide as much resistance as the lower quadrant. I'm having a lot of trouble talking. Okay. No, I just not by here. Let's go into the 1 minute. That's good, Obi. That makes a lot of sense. Glad. So this is what we're looking at on the 5 minute. Now we're on a 1 minute chart. So at equilibrium, do we get a prolonged consolidation? No. What do we get instead? We get 2 down close candles. Are we expecting it now that it's gone to equilibrium and we've just touched equilibrium perfectly to the tick? Oh, this is algorithmic precision, isn't it? We get 2 down close candles. Are we expecting it to reverse now just because it's traded into that SIBI and it's reacted off the 0.5 level? No. Because we have an underlying bullish bias. Just because you get a down close candle, be it on a daily chart, 5 minute chart, an hourly chart, 4 hour chart, you're still looking for higher prices because that's your underlying bias. Again, this only works in a market where you're one-sided, or you're expecting one-sided price delivery, a directional bias. Basically, this isn't going to apply in consolidating markets. So we get this order block, and then we leave. We don't sweep any lows. We take that, but that's not consolidation, is it? And then we trade into the order block, which we do on the lower time frame. And then we go up here, we get this consolidation, we sweep out the consolidation low, and then we trade back up into our terminus point. Now, implied ranges, because in hindsight it's easy to see where price went. Oh yeah, it went all the way up here. And now you get more accurate readings. In real time, you're not going to have the luxury of knowing where price has already gone, are you? So, are you aiming for the most low-hanging fruit objectives? No, you want to still be realistic in where price is going to go. So this was the 22nd of August. Everyone was really heavily bullish on the 22nd of August. So you could have looked at this as your implied dealing range high. Or this. I mean, that's a stretch, but you could have looked at this. Put that on a 5 minute chart. And then again, we're looking at anything past point of origin of the price move. Point of origin being here. Why not anything to the left of that? Because we don't have the implied dealing range, or the implied range, sorry, until we get to the point of origin where the impulse price swing begins. Then if I get rid of this, page tuning in, for example, this week we had bearish weekly close and we're in a fair value gap on key. We have bullish engulfing candle and the response was fair value gaps. What we'll be looking at. Weekly outlook is tomorrow, Braden, so you can watch that. For now, I want to teach this. Apologies, my friend. Okay, so looking at this as your implied dealing range now. What do we have? So at 0.25, we get this order block. Again, that's that little retracement. We don't require consolidation. We can get it. It's fine. It's better to get it, but are we requiring it? No. So if you weren't one of those lucky people who got in the discount of the implied range, discount being this entire thing from the origin into equilibrium, did you miss your trading opportunities to get into this high? No, because you still have the opportunity to get in once price sweeps this low, or when price trades up and then trades into an order block. Now here's an example of price not giving you that retracement or that pause point at the 0.75 level. So at the upper quadrant here, it just shoots through. That is way more likely to happen at the upper quadrant than the lower quadrant. If you're bullish, for bearish, you just flip it, so it's the opposite. and then you want to drop time frames. Say this wasn't enough for you this is equilibrium, by the way. Say you wanted to see this low swept. Well, this isn't part of the consolidation, but say it was, and you wanted to see that low swept and you didn't get your entry. What are you looking for now? You trade higher, you're looking for price to trade into an order block. Like I said earlier, this is the third and final trading opportunity of price swings. That's this order block, that's this order block. See what I mean? Okay, someone DM me a question about the consolidation. So the consolidation, it doesn't need to be a prolonged consolidation. For the algo, the algorithm that's delivering price, it can consider this little retracement enough, so don't be disheartened when you don't see that full consolidation. A retracement is enough for IPDA to operate, so when you get this order block and you trade above it and you trade into it, that is enough for IPDA being interbank price delivery algorithm. I feel like I'm waffling now. So what time frames are we looking for this on? High time frames are better. Yeah, it works in the 1 minute. Should you be trading it on the 1 minute? Should you be looking for this on the 1 minute? Generally, no, because if you can combine it with hourly, shut up, Clinton. If you go into the hourly time frame and you're looking at this, here's a perfect example of it happening. So this is your point of origin. At equilibrium, instead of getting a consolidation, you get order block, trade back into it and you go higher. I've lost my train of thought. What was I talking about? Time frames. So when you're on the hourly chart, because price is fractal, you can use the idea of this setup happening on the hourly. So this, and then this, and then this, and then you drop your time frame. So say you're on the 15-minute now. Now when you're looking for consolidation lows, you're getting better entries and you can position yourself better than you can on a 1 minute, because dropping from a 1 minute to a 15-second time frame isn't as useful as being able to drop from the hourly to the 15-minute to the 1 minute. So like here, you sweep out this consolidation that happened at equilibrium into the fair value gap, into this bullish order block. Then you trade back into this order block after you trade past the upper quadrant, and then you go into terminus. Does that make sense? Does anyone have any questions? So with these three trading opportunities, again in discount, when you sweep the low of the consolidation in equilibrium, and when you trade into the order block of, so once you trade past the upper quadrant and you trade back into an order block, being this one, the three trade opportunities come once you've graded the range on your chart, and then you're waiting. What are you waiting for? You're waiting for the market to show you that it's going to move towards your terminus point. So here, this displacement higher, and you get this market structure shift. Isn't that the algo telling you it's going to keep running up? Because now you've changed your state of delivery, you're entering a buy program. So you've waited for price to basically tell you it's going to its terminus point, the terminus of your implied dealing range. Or in other words, you draw liquidity. Then you wait for the algo to cause consolidation in the market, being this. These, what's that? 4 hours of consolidation. Then you're looking for them to drop price below that consolidation to pair the orders of large funds with all the sell stops that were below the consolidation low. So retail traders, think from the mind of a retail trader. When they're getting caught up in this mess and their sell stops are at the low of this consolidation, being either this or this, and large institutions and banks are forcing their money into the market, $50 billion at a time, they need somewhere to put their orders, and that's below here. That's why this will never stop working. That's why the algorithm's like so easy to believe in, because when you have large funds that need to put money into a market, they need people on the other side of the orders. So they need this to occur. Without this, there isn't a market. You know? So the orders of the large funds are being paired with all the sell stops that are below the consolidation low. What if you miss that? Say you don't get into this, or price takes off without you. So, like, say it didn't sweep this low and price just took off, or you missed the opportunity. When it goes into the 75% level, being this, you're looking for it to drop down into a bullish order block, being this, and then it does almost perfectly. If you could see a valid reaction of that bullish order block, obviously in this case, you know, that news candle came in, so it's crazy. But if you could see a valid reaction of this bullish order block, and on a 1 minute chart, here we go, this is what we'll do. 15-minute order block. This is why you have to pair it with lower time frames. Okay, it was a news candle, of course it was. There goes my perfect example. But say this wasn't a news candle and you just get a reaction of that 15-minute order block. You can buy that and you can hold it into terminus point. Well, your stop loss at either the low that sweeps consolidation that you missed, or at terminus, where you have an underlying expectation for the market to go in a one-sided move. Would you keep quite a tight stop with those entries? Say you're above consolidation or not late. Would you risk all of below or generally avoid it completely? Now you can have a tight stop loss. You can have a very tight stop loss. So back to the 15-minute. You sweep this consolidation low. If this is where the banks are entering in, why would we drop down below this low again? There is no reason to. Forget the PD arrays for a moment, just think of liquidity. So if orders are being paired down here with banks, this is retail, this is where retail's getting caught up, the algorithm drops it below the low so that anyone who's trading billions of dollars, large funds and institutions and central banks are getting into the market. Are we going to drop down below their entry price again? Obviously their entry isn't just one specific price point, it's gradual, so it's here, going up. Because they can't put $50 billion of money into the market at once, it needs to be done gradually. Are we going to drop down below this low again? No. We shouldn't if you're correct about your terminus point and about being in a one-sided market. So if you're positioning yourself, and I don't really want to be doing this, like giving entries, telling you where you would enter. But if you're positioning yourself, you're aiming for terminus of your implied range, and you can have very tight stop losses, like that, paper thin. Why? Again, there is no reason to drop down below this low if you're correct about being in a one-sided market. Say, how do I do it? I don't really know how to display this, but say banks are buying, banks bought here, and banks bought on this bullish order block. Each time that happens, are you trailing your stop loss? No, it's not good practice to do that. Yeah, it's really not good practice to do that because you can easily get wigged out. So you can keep a tight stop loss. If you've swept consolidation low and you've missed that, you can have it at consolidation low. If there was no sweep of consolidation lows and you just trade into the bullish order block, pretend this little wick here isn't there for a moment, and you trade back into the bullish order block, where are you putting your stop loss? You're not putting it at the consolidation low, you're putting it below so that you still have enough room. So if price does want to sweep the consolidation lows and get that fuel it needs to go into a terminus point, especially if you're using a terminus point that's far away. So in this case it was 120 handles. But imagine you were using this as your terminus point, or this, or this, or this. Then you still need that fuel. Fuel being the analogy of liquidity, opposing liquidity. So you want to have, if you missed the trade opportunity and it didn't sweep the consolidation lows and it trades into the bullish order block and you think it's going to go without you, you can enter on that. That's the final trade opportunity. With a stop loss that's wide enough to allow price to wick there. What does that mean? Well, that's where we go into average daily ranges. Just a little touch on that. You will look at the average range of this entire price swing. You take 20% of that. So here we have from 081 to 200. That is 204 handles. 20% of 200 handles, what's that? 40 handles. So if you entered there, you would use 40 handles below the consolidation. So consolidation's there. 40 handles minus 23,224.75 is 23,184.75. So that would be your trade. If there was no sweep of this consolidation low and you were expecting it or allowing for it to happen and you wanted your stop loss in a safe enough place, that's basically what you do. Okay, back to why the concept works, back to why this will never change. So when money's flowing out of currencies, and let's say you're looking at commodities like gold, and money's flowing out of the dollar, out of the pound, out of the euro, where's it going? It's going into commodities. So everyone knows in the Discord that sometimes I trade gold, but it's rare and I only ever position myself in buy trades. So if the euro's going down, this is the euro, it's going down, and this is the dollar, and the dollar's going down, and this is the pound, and the pound's going down. Let me do that. Three major currencies are going down. The money that's coming out of those currencies is going into commodities. What's the main commodity that people put their money in? Gold. So if money's going into gold, you can anticipate a one-sided market. Obviously, we haven't got that condition where we have three bearish major currencies, but pretend we do. It's kind of hard here. Pretend we do for a second. And this is your implied range, and you're expecting one-sided market delivery because of... In fact, let's spice it up. No. You're expecting one-sided price delivery because of the fact that you have three bearish currencies, money's coming out of three currencies, going into commodities like gold. Yeah, water. You can position yourself using this tool. So in this case, you would drop down timeframes looking for sweeps of consolidation within these boxes again. So those 3 trade opportunities I mentioned, where you create the order block at the upper quadrant and then you trade into that. So on the daily chart we've got this down close candle, and then we validate that as an order block by trading above it. On a 4-hour chart or a 1-hour chart, you could have used this as an entry point, because on a daily you don't get that opportunity because it just takes off. On a 4-hour, when you close above it with a 4-hour candle, you would have definitely got an entry into that. So that would have been your 3rd trading opportunity. This retracement, so this bullish order block, that on a lower time frame is going to be consolidation. And then if you trade anything below that consolidation, you could enter there, or you could enter in the discount, which is where you get your highest probability entries. And my voice is going. I'll take it on a 15-minute chart. Wait, I had examples that I was going to use, I just forgot to use them. Got a load here. Consolidation, it doesn't sweep the consolidation, it trades into 0.75 and then it trades into the order block and then it goes higher. There isn't that much to show on this one because it didn't sweep any consolidation, but if you go into lower time frame, and this is why it's beneficial to do it on high time frames, because you can drop time frames, and then now you see how much more obvious it is that where we consolidated, we drop down below that consolidation with a fair value gap, and then you take off. So consolidation, expansion, consolidation, expansion lower, sweeping out the consolidation, causing more consolidation, this is a mouthful, and you expand higher. Consolidate again, expansion, consolidate again, expansion, consolidate again, expansion. So as long as you can identify your implied range and you understand the concept of price delivery between consolidation phases and expansion phases, you're going to have no problem identifying any of this. And I'm tired. There was one last thing I was going to go through and I just forgot. Let me check my notes. Oh yeah, so how can you use this idea to hold on to trades? Because I had like 3 people ask this question in DMs. How do you know when a trade is reversing on you or if it's just a retracement before it goes higher? Like, how do you know it's not just gearing up liquidity and accumulating and engineering a low for it to be swept and then run up into your take profit? Well, this is how. Using this concept of swing grading, you expect this consolidation to be swept. So when you see this here, am I expecting a full outright reversal? No, because I have an underlying bullish bias that we're going to trade into these relatively equal highs. And I see down close delivery like this. Am I worried? No, not until it comes like past this protected low or this protected low. The consolidation low is here. Once it trades through that, I would pyramid my entry. Get shaken out of it. That's what you want to add to your position, because now, as long as you do have that bias and you're correcting your bias being a one-sided price delivery higher, when you sweep this consolidation, that's how you're going to gear up and add fuel to the buy-side delivery. So this is going to teach you to trust your initial trade idea. There was one last thing. The benefit of doing this on a higher time frame is that you don't even need to get your terminus completely correct, because when you drop down to that lower time frame and you have the lower hanging fruit objectives and you're still using the implied range from a higher time frame, even if the terminus is incorrect, it is like, as long as price is going to trade through that, it's not the final terminus point. It doesn't need to be. So if you pick this is perfectly fine. It doesn't matter if price trades higher into there and that was where price stopped, or this was where price stopped. The fact that price trades through this level validates this as swing grading, or as a graded swing, graded implied range. Final notes. Remember, it's only for trending markets, not consolidating markets. It's fractal, so do it on high time frames. Clinton, nice shit up. Rude little boy. Yeah, that's it. That's the lesson.